Welcome to the daily update, where I'll go over the action in the market for Thursday, October 23rd, and we'll see how things look for Friday, October 24th. Okay, kind of deja vu all over again. We've been here before as far as price, where after Wednesday, not looking quite as good. Now, after Thursday, we're tilting back more to the positive side, but we haven't really broken out of this range that we've been in. Now, we're supposed to get CPI on Friday. We'll see if that actually comes out and what the result will be. The market is still looking positive on all three time frames. And so there's the possibility of being able to build on something and have us go up. Of course, if we get the CPI report, if it's mixed and the market's confused, we'll probably just continue to chop around. Of course, if it comes in hot, that could send some fears throughout the market. So there's a lot of geopolitical things going on now. There's sanctions against Russian oil companies. That's really making oil go up, which gave some support to the market because then the oil companies are looking a little bit better. And mega caps had a pretty good day. We saw pretty much a broad advance, but we're not really going anywhere. It's more of a treadmill type action when you look at the daily chart. So right at the open, we had a higher open. And we chopped right after the open. The market was trying to figure out did it want to go higher or lower, but we tended to chop up. We got above the 67.25 level and R1 at 67.42. We did hit resistance again, a round number, 67.50, and then we closed slightly below R1. So we trailed off a bit going into the close. We were up 0.58% on above average volume. So volume has been fairly healthy, but we have a down day or an up day. We're just kind of churning right now. We're positive on all three time frames. Interest rates did tick back up with the 10-year yield, but we're still under that 4% level. And a lot of things going on. The market's really concerned and focused on anything between US and China as far as the trade wars going on. Now you've got Russia and that situation kind of stepping back in. So we'll see what actually has an impact on the market and what does not. So some comments. It was a broad-based advance, and mega caps and tech had a good day. And earnings reports, they were taken more negative on Wednesday. Well, on Thursday, they were taken more positive. Now, a lot of the big mega cap stocks are going to report next week, so that could have an impact as well. But we're kind of seeing things where the indexers are not really moving around all that much. This is one of those times when it's more individual stocks can have big moves, but it's not really coming through to the index level. And the Treasury Department announced sanctions on Russian oil giants Rosneft and Lukoil. Okay. And there's growing optimism again. Now, Wednesday, things were more pessimistic. Thursday, things were more optimistic of a potential trade deal between the U.S. and China. President Trump will go to Asia next week, where he's expected to sign trade agreements with 12 countries. So the market liked that. He will meet with President Xi on October 30th. Wonder if they're going to do any trick-or-treating together to discuss a potential deal covering soybeans. Got to have a deal on that. Rare earth metals, which is a big deal, nuclear weapons, and of course, the all-important TikTok. Trump also noted that he does not want China to face these really high tariffs. He would like to be able to work something out, thinking that they're unsustainable. Now, we're seeing a little bit of a drift more to the positive side in the short term. We have the Williams percent R, which is back on the list, the stochastics, which never came off the list, but there are three different subdivisions of the short-term time frame on that chart, and we'll go through that. No change to the overall scenario for as far as the Fed is concerned. The dollar was up, interest rates are up. We're at 3.99% with the 10-year yield. Sentiment ticked up a little bit. We're still negative when you look at the number by itself, but it did tick up from 26 up to 28. And we're still negative. We have the red line above the green line with our ADX chart. So that has not switched over positive. Some of our other charts are looking a little bit more positive. We're still seeing a weakening trend because we're chopping around right now, but we're above 20, but we're still below the moving average. And with the update, the bias is positive. I'm keeping the momentum at mixed just because we're really not going anywhere. So we did get an economic report. here. Existing home sales don't have a chart to show you to go with this, but we can just look at the numbers. Up 1.5% on a month-over-month basis. When you annualize that, it came in at 4.06 million, a little bit more than the 4.05 million that they had expected. Last time we had an annualized rate of 4 million, so a bit of a tick up there. On a year-over-year basis, existing home sales are up 4.1%. We have been seeing interest rates coming down. Housing prices really haven't dropped, but the lower interest rates are at least helping sales a bit. So no charts to show there. All right, Real Investment Advice has another interesting chart here. The cumulative change in share buybacks against the S&P 500. And everything is going up and to the right. That's really the takeaway from this, is buybacks are seen as something positive. And we remain structurally bullish. I don't know how that's different than other kind of bullishness, but and still see upside risk to our $4,900 tons in 2026 forecast. Okay, because gold's been going up, naturally all the forecasts are for it to continue going up. That's really the takeaway from this. And of course, you have to ask, why is gold going up? The stock market's doing okay. It's not falling apart. It's not really going anywhere. Interest rates are not really a problem at this time. The dollar could stand getting a little bit stronger, but there's probably some strategy behind keeping that weak. But you've got all these crazy things happening in the world, and so there could be some bigger picture strategic maneuvering as it applies to gold. We'll see how that starts to play itself out. But there's not a real surprise here. The 10 largest companies, they make up most of the market cap, and they also account for a heavy portion of the earnings in the S&P 500. Equity fund flows, seeing a lot of money. This is growth, tech, financials, which are not growth so much, but we like when the financials do well, but they're still not outperforming the S&P. Materials, which really got hit on Wednesday, they bounced a bit on Thursday, and industrials. So seeing a lot of money going into those areas. And these are when the economy's doing well, when growth is doing well, that's where you tend to see most of the money going, where the other sectors are actually negative. Okay, cumulative trailing 12-month U.S. mutual fund and ETF flows. Still, not real a surprise here. We see most of the money going into money markets, and that's as far as it goes, because you get a better rate of return than you probably get at a savings account with your bank, and it's just as liquid there. But we're seeing a lot more money going into bonds, and we're seeing money going into stocks, but not as much as what we're seeing going into bonds. All right, forward PE tells us what we see pretty much every day. We're overvalued. When you take everything together, we're at 23 times earnings. When we get above 20, that's when we're expensive. If you just look at the equal weight version of the S&P, we're more fairly priced. We're that 15 level is considered to be fair value or fairly priced, and we're a little bit above that, but still under the 20 level. And what's the probability, according to the yield curve, of us going into a recession? Still pretty low overall. Really hasn't changed all that much there. And then the S&P 500 3-month realized average stock correlation. And this is what I was kind of talking about, where we're not seeing the indexes moving with a lot of conviction right now. It's more individual stocks, and it's kind of borne out in this chart. Low realized correlations across S&P 500 stocks signal more discerning market, where sector narratives and company fundamentals are reclaiming the spotlight. So it's on a case by case basis. Then stocks and earnings estimates are both at records. That's why the market's going up here. It ultimately is earnings. And then 95% of reserve managers expect global central bank holdings gold to rise. Yep. A lot of people, a lot of governments are buying gold, and they expect that to continue. And then this is, since we're dealing with the shutdown, today the US government shutdown officially became the second longest. And I remember the 95, 96. I had just kind of gotten into the markets at that point, and they shut things down and, all the political stuff. I mean, you're hearing things about the government shutdown, but it's not as, they're not playing as much of the game this time that they have in the past, at least based on what I've been hearing. And because there's so many other things going on right now. But yeah, and we'll just have to see if this gets worked out somehow or if it continues to go on. It really kind of impacts us in the stock market because of the economic reports that we're not receiving. Bankruptcy filings are actually going down here. Um, and it's one of the most leading hard data points for credit, actually going down a little bit according to this chart. And then the CPI, when we get this out, and of course you could stop this and say, okay, what happens with the CPI readings and then what they think is going to happen with the market, but who actually knows? And oil against the sanctions here. Quick reminder that no past round of Russia sanctions led to sustained spike in oil prices. We're not as bound to them. We are, but not as much as we have been in the past. Even when OPEC comes in and says we're not going to produce as much oil, which usually makes the price of oil go up, the latest sanctions won't either. Best example is the huge wave of shadow fleet sanctions by Biden in January 2025 here. So it, we are seeing oil going up, and we do watch it mainly for geopolitical reasons, but it might just have more of a short-term impact on things, according to what has happened before. All right, so had a higher open, and then we chopped around quite a bit here, around the 67.25 level. Never did come down and really test the unchanged level of the daily pivot, and just looked like, okay, we're just going to bounce along sideways. But then later in the day, we saw a break above 67.25. We got above R1. And then we held on to the majority of the gains, but saw a little bit of a drift down going into the close. Now, one thing that I was watching for is that we saw a nice little bounce on Wednesday. We were really going down, but we closed well off of the lows and saw good momentum heading into the close. And other than the choppy start here, we were able to continue with that. And so we're improving, but we still haven't surpassed the high that was set back on last Tuesday. So we're still inside of the range that we've been in now for a number of days. And not a big change in the initial overnight session. But again, what we've been seeing is the futures are either positive or negative, but we're seeing most of the price action actually taking place while the market is open. And the red line's still above the blue line, but again, we're not breaking out of this range that we've been in lately. And we were hoping, going back to the beginning of August, seeing this continue to go up, and it's just kind of stalled out right now. And this is not showing all that much improvement either. With the growth to value ratio intraday for the S&P, we got back above the moving averages, but we're just back up to the lower end of the range that we've been in now, going back into September. So end of day growth was up more than value. Not a surprise there, and that's a more positive day. It was up more for the mid caps, but up less for the small caps. But we did see a bit of a bounce here with the small cap growth to value ratio, but still we're range bound with this overall. A little bit of a tick up with the mid cap growth to value still above the 50-day moving average, and not much of a change and still below the 50-day moving average with S&P growth to value. And this is the area that we want to see doing better to really drive the index higher. And it's just chopping along and actually showing some weakness going back to the beginning of August. And just going along at the top end of the rainbow with this growth to value ratio, a little bit of an improvement, but we're just hanging out around the 50-day moving average when we look at discretionary to staples. Then looking at the trend, we're still going down. Now, in the short term, we're barely above 20. We're at 20.29. We drop below that. That means we're in a non-trending environment in the short term. It's still weakening because it's below the moving average, and it's still negative because the red line is above the green line. Still going down here with the intermediate term ADX below the moving average, red line above the green line. This is a little further above, coming in at 22.11. So we have a little bit further to go before that might enter into a trendless type of state. And we are above average with volume. It dropped off from Wednesday, but still above average nonetheless. Then looking at sentiment here, I didn't have the gamma chart yesterday. It just didn't update. So, but it was updated here. Looking more positive, 67.38 now. That's where we closed with the S&P, the green. And we are looking at these different areas as far as overhead resistance, the 6750 level. And we're not quite there yet with 6800, but this is leaning more positive currently. Still above the moving average with the Ulcer Index, which is an end of day attempt to measure fear in the market. And that's still above the moving average, but it is starting to flatten out. And we're continuing to drop with the VIX. We're below 20 and declining, both with the line chart and the bar chart. And the seasonal pattern, which we really haven't followed all that close in 2025, and dropping down a bit here since we had the update with the VIX of the VIX. The bar chart is starting to drop below the moving averages, as is the line chart. It's still up in the red area. We don't know when we're going to top out with the skew index, which when we're in this red area, that just means the market is expecting some kind of a big move. We're not quite sure whether that's an up move or a down move. This could be some positioning coming in if we do get the CPI report coming out, which it looks like we're going to get. But the way things have gone lately, it's like, okay, we'll believe it when we see it kind of a thing here. So this could be some option positioning ahead of that. And we did go down with this fear gauge since it was an up day. And let's see, the other fear gauge also declined. And then in the middle here, we had the latest reading of individual investors. Still net bearish overall. When you look at the survey here, it improved a little bit. We were up from the reading a week ago, but still below zero overall. And here's the other fear gauge. We did see an improvement here and a little bit of a breakout with the high beta to low beta. The other ratios that we look at are just kind of chopping around sideways. And you could say that for this as well. But I decided to show this chart just because it was a good day for high beta stocks. And these are the big stocks that really drive the market up. But can we break out even more and continue to go up with this chart? That would be more positive. And a bit of an upward move, even with the up day. We did go up with the equity put call ratio. So we're going up with the 5-day chart and the 10-day chart, which is typically seen as more negative. Still getting a low reading, though, in the band with the volatility risk premium. So not getting an awful lot of fear registered according to this measure. And not setting a new all-time high with the advanced decline line based on price. We actually were flat to slightly declining based on volume. Not a real strong day with volume. We did get back up into this range here based on price, but you notice we had that big down day back on October 10th. We've been inside of that whole range since that time. We have not broken out above it, nor have we dropped down below it. We've just been meandering around within that 1 day range. And a little bit of a tick up and still above zero with the short and intermediate term advanced decline ratio. A bit of an improvement with the advanced decline oscillator above zero and advancing. And a drop off here with the new highs. We're trying to improve with the 5-day chart, but we're pretty much flat where we continue to decline with the 10-day chart. Turning back more positive with our three smart money indicators. We're coming back above the moving average here with the boom indicator. Still going up with the Chaikin money flow. The red line is advancing, and we're going up above the moving average with the Chaikin oscillator. But we're still negative with the vortex and see all the choppiness. This is what we've been seeing as the market really has been range bound lately here. This is still negative. And a little bit of an improvement with the advanced decline line studies above the moving average with the NYC common stock. A little bit higher here above the moving average with the S&P. A bit of a bounce up with the mid caps and not quite back up to the moving average with the small caps. And we're still above zero with those stocks inside the S&P above their 20-period moving averages. A little bit of a tick up, also above 50 with the 50-period moving average study. We were flat with the 100-period moving average study, but a bit of an advance with the 200-period moving average study. So just kind of range bound here. Are we going to be able to break to the upside or are we going to see some more weakness here? We don't know that yet. And the market doesn't know that yet. That's why I can't seem to find any real conviction, especially in the short term. But we are above average with volume. So a bit of a tick up here with the 20, 50, and 200-day moving averages on the S&P, climbing back above the midpoint with the Stochk RSI, but not showing any positive short-term conviction. We are back up showing some conviction here with the Williams percent R, and above the midpoint with the CCI 14 and CCI 20, but again, not showing any short-term conviction. So the short term, we're back to looking extreme. Intermediate short term, just starting to go above this green line, even though the chart's rolling over a little bit. So we're seeing the short and intermediate short term looking extreme here, where we're positive with the long short term stochastic and above the midpoint with the force index, but not an awful lot of movement right now. And above all three moving averages, the 10, 20, and 30s here. So this is holding up in the short term. And we are going back up with the green line and the blue line with the short-term trend based on 20 periods. We're above the 20 period simple and exponential moving averages. We're going to be watching this if we see any downward move on Friday to see if this ends up providing some kind of support. We're above the midpoint in the +1 channel with the standard deviations chart. Just not seeing a lot of conviction here with the balance of power, but we are positive. We're positive with the go, no go, positive with the highest high value chart, still counting away on the Landry Light upward trend as well as the proper order trend, but we're still just kind of dragging along here with the TTM squeeze. It's not really turning much more negative, but it's not switching back and looking positive either. Still below zero with the ease of movement and now trailing along under the zero level. And still slightly negative here with the Arun as sellers are slightly outweighing buyers. And a bit of a tick up and above zero with the S&P McClellan oscillator. So we're going up based on price, but we are declining based on volume. So we're getting a mixed picture here. This is when I say volume wasn't quite as strong on Thursday. It's mainly this chart. It's actually declining. And we're above zero with the NYSE McClellan oscillator, so we're ticking up slightly here with the summation index based on price and volume for the NYSE. And we're back to positive again with the Swindler Trading Oscillator, advancing based on price and volume, showing a little bit more enthusiasm based on price, kind of lagging behind here based on volume. And momentum is still drifting down, though. We're negative with the PMO, but we're going up based on price. We're lagging and actually declined a little bit here based on volume. Again, another indication that volume wasn't confirming the upward move that we saw on Thursday. But we are above 50 with the PMOs that are rising, going back above 50 with the buy signals, and flat, but still above 50 with the PMOs that are above zero. Positive with the Elder's Impulse system, positive with the parabolic SAR, flat here with the slope oscillator, flat with the MACD. So in the short and intermediate term, they're trying to improve, but pretty much flat right now, where we're still negative in the long term. Looking at those oscillators, and we continue to be long-term or negative here with the longer-term Copic curve oscillator as well. Flat, but still positive with the Sean trend meter, still above 50 with the money flow and ultimate oscillator, above the moving average with unbalanced volume, above 50 with the intermediate and short-term RSI. Still positive. We're going up with the bullish percent index, and we're above the moving average. So this chart is positive. A little bit of a tick up, but not a big change with the NYSE bullish percent index. And we are going up slightly. There could be some mega caps in the NASDAQ 100 that are showing some buy signals there. Intermediate term trend trying to go back up here. So that's still hanging on, even though we're below both of the lines. And we're above all the plotted moving averages. So that's why we're positive on all three time frames. We're still more than 10% above the 200-day simple moving average with the S&P. That's when we start to watch this. We start to get overextended here, and that can often lead to a more significant decline. And mass index, still waiting to see the line come down to this red dashed line. That's when a trigger will actually, all three criteria will be met, and this tries to anticipate a reversal. But reversal from what? I guess you could say we're going up here, but we really haven't broken out of this range. And we're still above the mini rainbow, where we came back down into the rainbow after Wednesday. We're slightly above it after Thursday. And still looking okay here for the week. We're up 1.12%. So if we have a down day on Friday and it's less than 1.12%, we'll end up having an up week. All right, so looking a little more positive here with the Heiken Ashi chart. The Kegi chart is positive. The Renko chart is positive, but the three-line break chart is still negative. All right, and then longer term, not seeing much changes here, but holding on and looking fairly positive with the 150 and 200 moving average study. We had a little bit of a change here with the Zohorchak. We had been in a -6. Now it's improved to a -4. Not a big change, still negative overall, but at least it's going in a positive direction. And positive on all time frames with all the different indexes. Positive with the dollar in the short and intermediate term. So we saw more of the defensive areas here. Utilities, real estate, staples, they were down, but communication ended up being down, and that's a growth area. Energy, that's kind of going up because of the sanctions, and but then tech and discretionary were also up, and that helped the overall market. So some positive things right after the market opened, and then a little while later, things turned a little bit more negative as we were drifting down a bit here. With energy having a bullish MACD crossover, Canada is above 30,000. We got we closed just a little bit under 6,700 on Wednesday with the S&P. Well, we were able to get above that. Nasdaq above 22.8, 22.9, then down below 22.9 and it fell down later on. And then Staples had a BPI cross down below 30 there. And so the big growth areas, mostly green, not really anything all that strong. Tesla, Amazon were up for discretionary. Both Google stocks were up. Microsoft was virtually unchanged with Apple and Nvidia being up. Oracle was also up on the day as well. So we have the Dow not setting a high. We're still watching this R1 overhead resistance level. We came right up to it earlier in October, and then we set the all-time high with the Dow, but we closed off of the high on that day. We'll be watching to see if the Dow can get above the 47,092 level here on a closing basis. But we're positive with the Elder's Impulse system. Still pretty much range bound with the NASDAQ, but positive after being neutral with the Elder's Impulse system. Also up with the NASDAQ 100 and positive after being neutral with the Qs. Momentum still not really shifting over to positive, at least yet. And we did go up over 1%, but we're really chopping around here with the S&P 600 small caps. And we were up 1.27% with the Russell 2000 small caps. And after being negative, we're back to positive with the small caps, looking at the Elder's Impulse system, back above the 50-day moving average and back above this pivot point here with the mid caps, but still not really going anywhere overall. And after being negative, back to positive with the Elder's Impulse system, still above the 50-day moving average with the Wilshire and the total U.S. stock ETF. Financial sector, not up all that much, still below its 50-day moving average and continues to underperform the S&P. FANG index still hanging out above the 50-day moving average, up 1%, but not really breaking out, nor is it breaking down. So Apple was up 0.44%. We had Amazon up 1.44%. Microsoft was virtually unchanged, but still above its 50-day moving average. And we were up a little over 0.5% with Google. Meta was virtually unchanged, still under its 50-day moving average. Nvidia up over 1%, trying to get back above its 50-day moving average. And Tesla was up 2.28%, but it's been really range bound lately as well. And Netflix still not doing all that good, starting to drop below its 200-day moving average. So apparently there hasn't been enough of a pullback yet for people to want to come in and start buying, because for most of 2023, 2024, and 2025, this is a very good looking chart. I mean, you have pullbacks along the way here, but it's been holding up a little bit better. So at some point, you would think folks are going to come in and try to do some buying here. And a little bit of a drop down here with the short-term correlation between US and world stocks, still holding out with a fairly strong correlation in the longer term. Oil did bounce up over 5.5%. We're getting up into the 61 range again, where we had been in the 50s. And we're watching this. Now, this is a weekly chart, so it won't really be official until after Friday's close. But we came up about at this resistance level here, and now we've been starting to drop back down. So we'll see how this ends up finishing out the week. And we are seeing a bit of a bounce with the dollar, but it's still in a downtrend. And still under 4% with the 10-year yield, and coming down a little bit here with the 10-year based on price. Still above the moving average with the Qs to S&P. Not looking all that strong here. Right at a declining moving average with discretionary to the S&P, and just chopping along sideways a little bit above the moving average now when we compare large cap growth to value. So we're back up to the moving average with the large caps, trying to get up here, but still below the moving average with the mid caps. And after falling below the moving average with the small caps, we're now back above the moving average. All right, we want to do an update here. This is an explanation of the Hindenburg Omen. No spike, and we have until November 7th to see another spike on this chart for that to be confirmed. So ag NYC breadth thrust. We just have Friday's session, but that won't be updated until after Monday's session. There's a 1 day business day lag with this chart. So if we have a really strong update on Friday, CPI comes out and everybody's just ready to party, we might see this really do well, but it's not official until we actually go above this red line. And we won't know that until after Monday's close. So what's the outlook? We're still positive on all three time frames. We're supposed to get CPI, new home sales, consumer sentiment, and we're still dealing with the government shutdown and all these crazy geopolitical things that are happening. And we'll see how close things come to the economic calendar that's supposed to happen. This also shows what's supposed to be coming out on Friday. Seasonally, we are neutral to positive for October 24th with the Dow, where we're flat out positive with the S&P and Nasdaq. But again, we are in the week after options expiration, which tends to be down more than up going back to 1980. And then we do see a little bit of negative seasonality. That would come probably in Monday's session before we chop up, but nothing all that major as far as from a seasonal perspective when you look at just post-election years. Now here's another new chart. This is put out by Renmac. It says if you're a believer in seasonality, we are, but not blindly. That's kind of where I'm at. I just use it as a guide. It's just nice to know these things, but I don't make decisions around that. Then today is historically the best day to own the S&P for the next 3 months. Okay. All right. Yeah. And we're still in the second half of October, which tends to perform fairly well there. This will be the last time I show this chart in the daily videos. I'm going to switch it over and use it in the weekly video here going forward now because this is longer term. And we are dropping off with the buyback blackouts here, announcements, but they're still pretty heavy, but they are coming down. So the warning signs, we're still negative with the ease of movement and the oscillators for the S&P. The vortex is still negative, and we're still negative or not positive with the momentum of the Nasdaq 100. We're waiting to see if we get some kind of confirmation from the Hindenburg Omen by November 7th. Then on the positive side, looking okay with our three smart money indicators right now and the S&P and NYC McClellan oscillator, but the summation index for the S&P is mixed. We're going down based on volume and up based on price. Swell and trading oscillators back to looking positive again, as is the parabolic SAR. Growth to value, discretionary to staples ratios, longer term positive, shorter term showing weakness there. And the bullish percent indexes are still positive for the three indexes that are followed. The money flow, ultimate oscillator, and the financial sector continues to be positive until you compare it to the S&P 500. And the long-term special K oscillator is still positive. And we're running out of time with the ZWAG NYC breadth thrust. We'll have to see how that goes. All right, and here are the pivot points for Friday's session. Conclusion, no real changes here because we haven't really been going anywhere. We're positive because we're above the 20-period moving averages in the short term. We're above the 50-period moving averages in the intermediate term. We're above the 200-day moving average in the long term, but we're more than 10% above that. So we just want to be aware of that. Thank you. I hope you have a wonderful day, and I will talk to you in the next video.